Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, the banks are getting hammered today. We're going to talk about why and what that means for this entire market. Let's dive in.
Trade Genius.
All right, Bob, I'm scrolling through the bank list here and all I see is red. What's going on?
They started reporting today, and basically they're under reserved for losses. In their confessions to the analysts, they're raising the loan loss reserves going forward. And it's amazing to me. Yesterday we talked about how these guys get paid for being wrong at the Fed. Well, how do these analysts not know these things? Because we know they're compromised. That's why. And we knew this for months. Because you just have to look at what's happened with the credit card companies, and just look around, talk to people you know that people are at the end. And so people are walking away from debt now. And we haven't even begun. We haven't even gone into a recession yet, Phil. Can you just imagine when we're in a recession, what's going to happen with this stuff?
Right.
But look at JP Morgan. I was telling in the room, I said, JP Morgan, they were pumping it last week. I saw they're pumping this thing into earnings. It's going to get obliterated into earnings. And exactly what happened. What I'm worried about now is, and I'll give you the floor, is that one of the things that I was worried about going into this earnings season is that are the analysts over optimistic? And we're going to get through OPEX here, and then we're going to have a window before the Fed meeting that I think could be pretty red, from basically the July 22nd to the end of the month. So I think this might carry over to other sectors. What do you say?
Yeah, for sure. And if we're already dealing with this now, like you said, what's going to happen in 12 months, right? And that's why I think when people underestimate, and I get it, this market's been accommodated for the last how many years. Now we're starting to see things that we haven't really seen since 2008. And you saw a little bit of it with Silicon Valley Bank. That was quickly swept under the rug. But, that was only a few banks, right? So now this issue with these guys and earnings. And even though, we're talking about bonds getting back to prices that these guys originally got into bonds at, which is, I think, one of the bigger issues is the bonds are underwater on their balance sheets. But, if earnings are such that these underwater assets cannot be held to maturity, that's really the huge issue here, right? If they cannot be held to maturity, now the fact that they're underwater becomes an issue.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening. Look, we've seen this movie before. They changed the FASB rules in 2008, 2009, on mark-to-market stuff, because they used to have to mark-to-market as economic conditions changed on the loans. Now, you don't have to mark to market and report on any impairment unless you truly have impairment. So for an example, if you had a building and you had a loan out and it was $1 million and the underlying was $2 million, that's a loan that's in good shape. The guy's making his payments. So you had a situation, Phil, where you had a $2 million loan, $1 million loan on a $2 million asset. And great financial crisis, that really was a $500,000 asset. Well, they would have to mark that asset down to $500,000. And now they don't have to do anything unless the payment's not made. So I could just imagine when all these stacked up loans that people are trying to make by hook or by crook, they start walking away. The write-offs and the impairments are going to be astronomical, and they're going to be a major, major surprise to the markets, because everybody's looking at their balance sheet and say, oh, these guys are in really good shape, but they don't know, that assets are kind of prices are ephemeral. When I used to do M&A, we never really considered the assets somebody has on the book. We just looked at what kind of yield can they generate for me, because we just assumed that asset prices moved. The most important thing to us was what was the liability they had on the books, because that had to be disposed of. Either we took it on or the owners had to dispose of the liability before we would buy the company, or we would just buy the customer list out from them, not buy the whole company. And I think people are not expecting this this. Everybody always looks at income ratios. They never look at the asset impairment. I think it's going to be bad news, because I think it's going to come, and it's going to come hard. And my view, and I've been telling you this, you're probably tired of hearing me say it, but I think this is not a 1 year or 2 year event. We may come out of a recession, but I don't think you're going to see asset prices rise again like they did probably in my lifetime.
Definitely overdue for the correction that's coming. And so I guess safe to say we don't like bank stocks right now.
No, I never trade them, because this is what happens. They hide everything and then they blow up.
Right.
So guys, we have a really cool one for you tomorrow, because I think this is setting up, all this stuff is setting up to allow the Fed to lower interest rates. It's giving them all the excuses they need. Tomorrow, we're going to show you some data points that they have to cut rates. Wait till tomorrow. Thanks for listening. Bye-bye.
Trade Genius.